So now I'm recording. Yeah, I was talking for like a whole minute and I wasn't recording. Um, so you can tell I'm new at this, but I'm gonna get it down. So anyway, hey y'all, got something else to talk about with you guys this week. We're gonna talk about some strategies, not plays. As you can see, this little presentation thing over here. But first, before we get to that, I would like to ask you guys to please like and subscribe. I would do this in presentation mode, but still learning all this stuff, so I don't know how to do that while I'm screen recording, so we're just gonna leave it just like this, right? Okay, I'll just talk through the slides. So anyway, what we're going to talk about today, we're going to talk about covered calls, cash secured puts, how to trade them with the strat, what to look for, and of course I'm always giving some type of tips, right, and how to exit. All right, next, this is for you if you own 100 shares of a stock. So are you bag holding out there? Do you have like 1,000 shares of something? You should definitely continue watching this video so that you can learn how to make money if that stock is going down. You can also make money as that stock is going up. I'll show you in just a little bit. So it's also for you if you don't mind owning 100 shares of that stock. So way to make money, if you want to own it or to sell it against it. It's also for you if you know how to trade the strat, because this video is specifically meant for people who know how to trade the strat. But if you are new to the strat, you can check my link that's in my bio. And I have a free resource guide there where you can learn everything about the strat. All I did was like put together all the resources that I use to learn the strat, and I kind of made it like an easy guide, because when I first learned strat, I kind of was all over the place. But this is kind of you should watch this, and put these things together. So and also, I guess if you don't trade the strat, whatever strategy you have, this will work with. All right, so we're going to talk about covered calls first. And covered calls is a bearish strategy. So you're basically stating that the price will stay below your strike price, right? The goal is for the contract to expire worthless and keep shares. And implied volatility is your best friend. So I want you to think about this like that. Think about it like this. If you are, let's go look at C, because that's my example today. If you are holding 100 shares of C, right, and you want to do, what happened? Oh no, I clicked on the wrong thing, y'all. I think it took me out. It did. Oh well, y'all gonna have to see it in Canva. I know one day I'm gonna go back on these videos and I'm gonna laugh so hard, but the important part for me is to get y'all the content. So if y'all see me mess up a little bit, it's alright, because nobody is perfect, right? Yeah. So anyway, alright, so with covered calls, you want it to expire worthless. So think about this like this. So if you were, looking at C, if you were getting in C here, right, for this 2-up continuation, you would buy a call and say your strike price would be 53, 54, right? So you would buy a call and say, oh, I think this price is going up. So there's somebody that sells you that call, right? That's where this comes in. Whoever sold you that call owned 100 shares of that stock. So they sold you that call thinking that C was going to get up to 54. So essentially, they actually lost on that position unless they got out of the position. That is one of the ways that you can, do it. If you buy it back, that's how you can get out of it. So it would, on their end, they would end up having to pay however much the contract maxed out to. Or, if they decided, okay, well, I'm going to buy it back, I'm already 100% down, whatever. Hopefully you wouldn't get that down. But somebody sold that call. So that's what you're doing. Okay. And so I wanted to give you an example on how you would use this, and I'll do that in just a second. But first, let me also talk about cash secured puts. So this is the opposite. Now, of course, just think about how we have calls and puts, right? Normally calls is bullish, puts are bearish. It's the exact opposite when you're selling. So when you're selling them, your covered calls are bearish, but your cash secured puts are bullish. And y'all, don't laugh at my little bull right here. Canva was giving me the most time today trying to find a bull. I really couldn't find a bull like graphic. Like, we're gonna even go back to this really nice bear graphic. Like, how is that so nice, but y'all don't have bulls? Like, they gave me plenty of cows. But anyway, all right, I'm getting off track. So anyway, this is a bullish strategy. It's the opposite. You are saying that the price will stay above your strike price, but you're also saying that you're willing to buy those shares at that price. So the goal is, again, to expire worthless, or you can buy those discounted shares. So moving on, we're going to go to this example. C for the covered calls, and then we're going to do SoFi for the cash secure puts. So for C, what you would do here is, if you were using the Strat as a reversal, I think, actually, I just had a thought. I know I wrote SoFi, but I'm going to use C for both. But classic 2 up, 2 down reversal, correct? Your trigger here is right around the 51.14 level. And what you would do is you would take this down. Your target would be 47, right? So essentially, once this triggered and you were taking this 2 down, you would sell your call for this trigger price, for the 51. So how that looks when you trade it. So if you, wait, what did we say? We said the 51 to 51. Right, so we don't think that it will get back to 51. Once it does the 2 down, we're thinking, okay, we can sell a covered call for the 51 strike, and we should have no problems, because we think that, our target is the 47. I say 47. Yes, right around 47. Okay, so what you would look for here, and it's a little bit different because right now it hasn't triggered. So, I would have to get one that has like already triggered. But I want to show you what to look for when you're looking at these contracts. Basically, you want a delta of 0.30 or below, right? So you would probably choose this one, which is 55. Take a look at the chart real quick. 55. I mean, that's all the way up here. I mean, that would be even safer if it triggered your 51. I mean, any of these strike prices within this bar would work. It would just be up to you as far as which one you wanted to sell to get the maximum premium. As you can see, it goes down, but it's also, it's $14 versus collecting, I'm looking at the ask, $13 versus collecting 30. Okay, so that is an example of how that would work. You actually would use the Strat in the same methods of as if you were buying a put, and if you have 100 shares of that stock, you would sell a covered call against it. So the opposite will work with puts. So let's give this another example. I almost said if it did this, but let's just use this example right here, right? So we got a nice little TTO. I mean, boom, like we've taken a lot of stops out. We might 2 up here, right? So if we wanted to swing this for a 2 up, our trigger here again, 51.21, right? We would say, oh, it bounced at 47. I don't think it's going to get back down there. So what you would do is you would come here and you would sell a cash secured put for this $47 strike price. And that's saying I don't mind owning these shares at $47 if it comes down here. And that's if, of course, you get all the way to expiration and you decide that you do want to buy the shares. Okay, so you would buy the 47, I'm sorry, you would sell the 47 put. I don't have all my strikes here. So let's see if we look at all of them. Oh, that's nothing. Ah, that's funny. Yeah, but you know, sometimes it works better on other ones. Like say this one, let's give a better example because we're current and it's not such a far away price. Let's say from here, if we were going to continue a 2-up continuation, and let's say it triggered, you know, we got a little bit of range over here. The broad information, you know, we might decide we want to come up to that broad information. So you want to say that I'm going to put my cash secure put here at 51 because I don't think it's going to go lower than 51. But if it does, I'm willing to buy shares at this 51 price. So then what you would do is you would sell a cash secured put. Say that fast 3 times. A cash secured put, you would sell that for that and collect that premium right there. So that's how it works for cash secure puts. And back to Canva. So of course I got some tips for y'all. I want you to remember, as I showed you in the examples, you want a delta of 30 or below to keep your shares or to avoid buying them. And again, you know, I kept this from the last presentation I had because it still applies. And I think it applies for most of the strat. If it may not always hit the target, but the move can still be profitable, and a lot of times it comes so close. So again, you know, the goal is to collect maximum premium. So this really is helpful if you really know your stock, and this is why if you have 100 shares of it and you've been holding it for a while, you should know how your stock behaves, right? It's great to play around earnings because earnings has super inflated IV. So what you would do is you would sell that call, and everybody knows right after earnings that IV just crashes and it caused the value of that contract to go down. That's good for you because you want to keep all of that money. Okay? And last but not least, I want to tell you how to get out of these positions. So with the covered calls, the same way that you sold your call, you will buy it back. That's if you don't allow it to expire worthless. If you know for sure that it's not going to go your way, if it's Friday afternoon and you know it's just nowhere near it, you can just leave it alone because it's just going to expire worthless. You're going to keep all that money and they'll take it, your brokerage will take it out of your positions after it's done. It's just yours. You got that money up front when you sold it, so you get to keep all of it. Now if you buy it back, obviously that digs into your profits because you bought it back, but initially you can, so if you get $36 initially and you spend $6 to buy it back, you net a $30 profit. So sometimes if you have, like for instance, I had a stock, I'm sorry, I don't have, y'all just gonna have to stare at the screen while I'm talking, but I had a stock where it gave me like, I think it was 75% profit within like 2 days. And even though I had 3 days left on the contract, I went ahead and bought it back because I didn't want to give it time to go against me again. You never know, you know, if you give it 3 days, it may just boom. So I went ahead and I bought it back when I had like $2 left on the contract. It was $2, you know. So the opposite, I mean, the same thing goes with cash secure puts. You sold the put, you will buy it back. And again, 70% profit is a good extra strategy. So that is all I have for you guys on that. If you guys have any questions or any comments, please let me know. I am here to answer any questions. I can make some more videos and all of that jazz. I hope you guys have a happy trading week, and I'll see y'all at the next video. How How do I stop this? Stop the recording. Can we stop this recording? Okay, can we stop that?